Insurance. It's one of those invisible things that helps keep the modern economy chugging along. Providing a financial safety net for consumers and businesses against all sorts of risk. Losing a job, losing a cargo, fire, floods, storms. But in the United States, the world's biggest insurance market, gaps are appearing in the safety net just when people need it most. Climate change is accelerating the risk from natural disasters. But it's also making it more difficult for people to insure their homes against destruction. It's resulting in a protection gap. And that could have implications for the US property market and the wider economy. So on this week's show, we're diving into the protection gap. It's what we do here on Reuters Econ World. Every week, we pick a phrase or buzzword and go deep on the economic principles and ideas driving the biggest news around the world. I'm your host, Carmel Crimmins, in Dublin. Disasters are the lifeblood of insurers, stretching right back to ancient times. The first forms of insurance were recorded by Babylonian and Chinese traders. To limit losses at sea, they divide their cargoes among various ships, spreading the risk. But in recent years, as the financial cost of extreme weather has climbed across the US, insurers are either jacking up the price of property insurance or cutting coverage. It's leaving American homeowners exposed to a hefty protection gap. And that's something that could mean bigger problems for them and the wider US economy. Because it means that buying a home, the traditional way that Americans build wealth, is becoming a greater gamble. In fact, some economists think that US home prices don't yet reflect the true cost of climate risk and say that's risking a new kind of housing bubble. I'm joined by one of them today, Penny Liao. She's a fellow at Resources for the Future, a think tank based in DC. Penny, welcome.
Thank you for having me.
Penny, we've had such extreme weather recently, like 2 hurricanes in the space of 2 weeks in Florida. But yet there and in other states like California and Louisiana, we've seen some major insurers pulling out of insuring homes. I thought natural disasters were insurers' bread and butter.
Yeah, you're absolutely right. I mean, underwriting for the risk is the entire business of insurers. So in general, they don't dislike risk, but catastrophic risk of this kind is particularly hard to insure. When very large losses happens, it creates a severe threat for insurers in terms of their solvency. Do they have enough capital to pay out all the claims that would be incurred in that event? And so they're constantly facing this dilemma of, okay, so when I see this very unpredictable event that I don't know when it's going to happen and how big the loss will be, it becomes very difficult for them to know just how much to insure and make decisions about capital reserve.
So why is it becoming so unpredictable?
Part of the reason is that because losses have increased so much, they also feel like perhaps some of the modeling techniques that they currently have is inadequate. There are major data gaps. And so not only are they facing more uncertainties, they feel like they might not have a good ability to quantify the uncertainties.
So on the one hand, you've got these huge storms and events that are sucking up a lot of the insurers' resources. And then the data from previous years isn't really accurately predicting the future risk. Plus there's restrictions, right, from state to state about how insurers can operate.
Sure. California is the one state that you most often hear people talk about, and they have a combination of things in their rate regulation. For example, if the insurer file a rate filing for rate increase, they need to justify their rate increase based on historical data in the past few decades.
Right.
However, if you look at wildfire losses in California, basically in 2017 and 2018 alone, 2 wildfire seasons have wiped out the cumulative insurance industry profit in the past 20 years.
Wow.
And not only wiped out, and actually they created like a deficit that is the same amount, so like twice that cumulative profit. And so these catastrophic events, if they are not allowed to take into consideration the future events like this, and just base all the rate increases on historical observations, the rates are naturally not going to be adequate.
Right. And there's a big economic impact from this kind of protection gap, right?
Yeah, exactly. And the welfare consequence of this is huge because if you think about what it means to have a property that gets damaged in a hurricane, the cost of replacing a roof is like it can get up to, tens of thousands of US dollars. The average flood claim during Hurricane Harvey was like more than 100K.
Wow. Like, who's going to have 100K lying around to pay for a new roof, right?
Yeah.
Very few people are going to have that kind of money.
Yeah, that's exactly right. And so business, it's the same thing. Like,
Right.
especially small businesses, if they don't have enough funding in reserve, what are they going to do? And so we do typically see that households or businesses who don't have insurance, their mortgage delinquency rate will go up. And so it will spill over to the mortgage market. Oftentimes, they will leave their properties unrepaired for a long time. And that would also have spillover effects on the neighborhood.
So you and some colleagues took a look at houses that were at risk of flooding and determined that they were overvalued. Can you just explain to us what your research showed?
Yeah. So we looked at the extent of risky housing overvalued across the entire United States at the county level.
Okay.
So we're able to say, okay, in each county, what is the extent of the overvaluation? We find that a lot of overvaluation happened in places that are at risk, which will mean Florida, a lot of places along the Gulf Coast and East Coast. However, we also find that a lot of inland areas are subject to overvaluation as well along the Appalachia, where actually we see some of the unprecedented damage from Hurricane Helene. We also see that Northeast, there are also a lot of areas that see overvaluation.
How much did your research suggest was the housing market overvalued by?
Yeah, so we find the ballpark estimate is between 121 billion to 237 billion.
And that's just for flood risk.
That is just for flood risk, yes.
I mean, there's a few things going on. There's an information gap. Sometimes people are buying these houses and they're not aware of the flood history, right?
Yeah, information is absolutely a very big part of it because we looked at what kind of factors are driving them. And one important one we find is whether the state has disclosure laws. These are typically laws that dictates that at the time of the housing transaction, the home buyer will be told the flood history of the house or whether this house is in a particular flood zone and whether they need to buy flood insurance. Because in certain zones, they are mandated to carry flood insurance.
Right.
So we find that in states with stricter disclosure laws, people do discount the properties more.
So in your research, on a percentage basis, how much was property overvalued by?
We find that it can go as far as 25%.
Whoa.
In some places. Of course, this is the only selected places. It's not like across the country.
Right. That's huge. I mean, that's kind of the magnitude of the price falls we saw, after the financial crisis. But after the financial crisis, house prices bounced back. Flood risk is something different. It's not going to go away.
That is a great point. Yes. And in fact, while the overvaluation is currently exists in the market, at some point it's going to adjust.
Mm-hmm.
And how it adjusts is very important.
Right.
Because it can fall suddenly, and that would have major implications to those people who currently hold these assets. It could create chaos in the market potentially. But one of the things we're currently working on with the same group of authors is to think about how can we have a relatively smooth transition where the risk gets incorporated.
Right now, in Florida, homeowners hit first by Hurricane Helene and then by Milton are focusing on the cleanup. Andy Sullivan has been reporting on the financial fallout from those storms. So, Andy, how big are the insured losses set to be in Florida from these two hurricanes?
Yes, at this point, the initial estimates are coming in anywhere between $35 billion and $50 billion, which is pretty significant. That is not as big as the doozies like Hurricane Katrina, which would be over $100 billion in today's money, but definitely substantial.
Now, Florida has some of the highest insurance premiums in the country, right?
Correct. The statewide average for what homeowners pay comes out to about $4,000 a year,
Wow.
which is about $1,000 more on average than any other state. Now, partially this reflects the fact that property values tend to be higher in Florida, but also it reflects the risk. I mean, this is a low-lying state vulnerable to sea level rise where it just gets hit by hurricanes every few years.
Your reporting also shows that Florida has a higher percentage of homeowners who have no insurance. How big are the uninsured losses from these recent storms?
We don't have that yet. And there's another factor to consider here is that when we're talking about property insurance, that generally doesn't cover floods. And in places like Western North Carolina, up in the mountains that got absolutely devastated by Hurricane Helene, we found that only 1 in 200 properties there had flood insurance. So these people are taking massive losses and insurance won't cover it.
You mentioned Florida property prices tend to be higher than elsewhere in the country, and the state got a lot of inward migration since the pandemic. Are we seeing this extreme weather triggering a rethink among some people?
So we've been talking to people on the ground in Florida, and the folks we've spoken to say, we're not going anywhere. We love it here. But you've definitely seen some indications that these insurance woes are affecting property sales more broadly. You see it in New Orleans. The state of Louisiana got hit by a bunch of horrible storms a few years ago. Property insurance prices went through the roof. And now realtors in New Orleans are saying that's really affected the market there. Sales are sluggish, prices are down.
Penny, Treasury Secretary Janet Yellen spoke last year about the protection gap potentially having cascading effects on the financial system. Can you talk us through what that might mean?
Yes, absolutely. So without the insurance payout and the liquidity injected by that, a lot of homeowners could potentially fall short on their mortgage payment and increase mortgage delinquencies. So that would have implications for the mortgage sector, which would mean, for example, some lenders who are holding those mortgages, they might suffer a loss. Sometimes the risk is securitized, which means that the mortgage is sold to the government sponsor enterprises in the US. And so Fannie Mae and Freddie Mac will end up holding those risks and suffer from those losses.
Now, mortgage lenders require homeowners to carry insurance. So, what are they doing to protect their investment in the event that insurers pull out of markets altogether or increase premiums beyond what a homeowner can afford?
Yeah, so you're talking about the requirement for mortgage holders to have homeowners insurance. And yes, a lot of the insurers are pulling out of some of these markets. And what happens is that homeowners who cannot get insurance will be going to their residual insurer in the state. These are programs like the California's Fair Plan or Florida's Citizens Program. Louisiana, Texas have them. A lot of states have them. And so homeowners can get their homeowners insurance coverage from those programs, but those programs tend to be quite expensive and the coverage tend to be more limited. And so overall, they are still more exposed.
So,
Yeah.
Penny, those programs are state backed,
hmm
right? So that kind of socializes the risk, right?
Absolutely. So the problem with those programs is that, they did a great service, I think, for people who are unable to secure coverage. But the potential problem there is that a lot of times the people who cannot get coverage are people with high risk properties.
Right.
And so what these programs are doing is that they're collecting more and more of some of the highest risk properties in the state. And so when a large event hits, their probable maximum loss, which is like the likely losses they're going to suffer, is going to be higher than any other insurers. And oftentimes, as you correctly point out, these programs are funded by some kind of cross-subsidization. They're not necessarily taxpayers. Like, for example, the FAIR Plan in California is actually a private pool, consists of like all the licensed insurers in the state. And so if an event happens that create losses above their reserve, what happens is then that they're going to start assessing all the insurers in the pool. And then the insurers might offload some of these costs to their customers.
Right.
And so sometimes it's customers of auto insurance can be paying for these things. And so the cross-subsidization definitely happens. It can be other policyholders, it can be taxpayers.
So there's that ricochet effect.
Yeah.
And then there's also, I suppose, the risk that if the bill is very high, that the federal government would have to potentially step in, right?
So currently there is no explicit channel that says if the insurance market fails, the federal government is going to step in and fund it. But as we know, the federal government often plays that role as an insurer of last resort for a lot of things.
Mm-hmm.
This happened during the financial crisis of 2008.
We are seeing some changes happening in the market to deal with the protection gap. California, for instance, is looking to change its insurance regulation to give insurers more flexibility around setting rates, including potentially using forward-looking models. And you can now select climate risk as one of the settings when you search for properties on Zillow. What are the other solutions that you think are needed?
I would say that the fundamental solution is to lower exposure.
Okay.
And what that means is that it requires like a system of changes. Locations need to implement zoning laws and building codes that are more forward-looking. Insurance pricing should be more risk-based to convey risk. And obviously, disclosure laws are very important. Risk communication is very important. So all of this is really about making sure that the housing stock becomes more resilient and there are less inappropriate development in places. I think that is really the fundamental solutions.
Politically, very difficult to do, right?
Yeah.
Because you're sort of saying to people, maybe you shouldn't be living there, or actually what you paid for that house probably isn't what its correct valuation should be. Like it politically, these solutions are hard, right?
Yeah, it is very difficult. Policies that facilitate what's known as the managed retreat, which is policy facilitated kind of gradual retreat from some of the riskiest areas. Those are controversial. A lot of coastal communities are very concerned about what that means for them. Local governments sometimes do not like it because it means that their tax base might be eroded as there are fewer properties that are in like these valuable waterfront locations.
So are you confident that the protection gap will eventually be, if not closed entirely, then at least narrowed?
I am cautiously optimistic to the extent that I think that the attention paid to this issue have just increased dramatically from, when I was a grad student to now. It's just a completely different levels of care and attention being paid to this. And also, on the policy front, also adaptation policy is such a new and emerging area. I feel like there's not a lot of research on it, and we are now getting like a deeper and greater understanding of new kinds of interventions. You see like creative solutions being developed by different localities in terms of how they implement their land use policies. And I think that it is exciting to see these changes. And the question is really like, can we evaluate them and implement them fast enough when it comes to increasing climate risk?
Penny, thank you so much for taking the time to talk to me today.
Yeah, it's my pleasure.
A big thank you to Penny Liao for her insights and to Andy Sullivan for his reporting. You can catch Andy's work on Reuters.com and the Reuters app. My colleagues over at Breaking Views, Reuters financial commentary team, have a new pod out called The Big View. This week's show is all about data centers and the AI boom. You can catch it on Reuters or wherever you get your podcasts. Christopher Walljasper was the producer on today's show. Sound design, music composition, and engineering on this episode was by Josh Summer. Our podcast team includes Kim Vinnell, Tara Oakes, Gail Issa, Jonah Green, David Spencer and Sharon Reich Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.